how can the lenders or the financial sector stakeholders take charge of the situation early enough to protect value? Should IBC be the last resort, or should it be the first and only resort? Or should the toolset for resolution be expanded from what it is today? How can IBC be strengthened further from where it is today? I think some of these questions we will surely explore over the course of this panel and seek the view of the esteemed panelists to these questions. But before that, I would like to invite Mr. Sudhakar Shukla, full-time director, IBPI, to provide us his thoughts. Over to you, Mr. Shukla.
Thank you, Mr. Dinkar, for this introduction and setting the context. Actually, the overarching theme is IBC and basically its journey during last 5 years, and perhaps debate around reimagining IBC in the context of growing challenges. So, and the sub-themes today's and this session's discussion include 4 topics, and all are very carefully selected, no doubt about it. But I am a bit wary of the fact that these, on one hand, relate to adjudicating authorities' decision, and on the other hand, it touches upon observations, recommendations of Standing Committee of Parliament. Therefore, I intend to use my time to tread a cautious path on all the issues which are getting media attention, oozing from these decisions and the recommendations coming from a standing committee. And from regulator, no one can expect more than this. So I thought I would be starting my few statements with the word of caution. So IBC law, as in the first session itself, it was highlighted, it is evolving, and the IBC law itself designed a gradual approach. Actually, it has fixed various milestones to be covered later on with the maturity of the systems and market. So good news is that with the availability of orders on DHLF, Jet Airways and Videocon, jurisprudence around resolution of financial services providers, cross-border insolvency and group insolvency has started taking shape. So this is a welcome issue, because these things were very much, at least cross-border and your financial services provider related issues were very much part of the statute. But moving forward with them, I thought building blocks were still to be constructed. Case in point is basically Jet Airways. Actually, it is how to deal with the assets and creditors of corporate debtors situated outside India. We had section 234 that cross-border can be tried through MOU route, basically involving central government. But invoking inherent powers, and NCLT has proceeded to give this judgment. It is landmark in the sense that it paves the way and first case of cross-border, but it also points that now as a policy makers, regulator and the government have to think more and see that if we can bring about more unified regime under UN Citral Model Law on cross-border insolvency to be inducted in the code itself. And this has been the recommendation of Insolvency Law Committee, and MCA has constituted a committee to look into this. The report of the committee, Dr. K.P. Krishnan committee report, is already with the government, but this was later intertwined with the second aspect, which Videocon judgment brings in, is related to group solvency issues. So though it tries to make a consolidation of 13 companies, still I think newspapers have covered a lot of takeaways from Videocon industries, questioning the haircuts and even some other issues which I will touch later. So this is basically this committee, which was formed to deal with the cross-border insolvency, has also been entrusted to deal with the group insolvency issues, and that recommendation of the committee is likely to be available in another 2 weeks or so. So they have already completed, deliberated, so final touches are being given. So with those recommendations available, I hope that more concrete regime on these two missing links, basically on unified approach to cross-border and also to group insolvency, would be going into the code in due course. So this is very important from the investors' point of view. It is very important from the point of view of foreign investors to be part of the unfolding story to deal with the stressed assets in the country. So that's what we hope how it would be proceeding. So basically, if you see that the third judgment basically on financial services provider, DHFL, is also a welcome first, in the sense that first time FSP rules and the statute was tested, and it came out very clearly that these are robust in nature, but they throw some challenges as well. So some challenges, how they have opened up many other things, would be a part of like my few points which I wanted to respond today. So basically, so apart from issues related to policy consideration, which I have highlighted on cross-border and group insolvency at the macro level, oozing from these decisions, several micro-level generic issues have also popped up. And these I wanted to touch in my remaining time, basically. This is basically, if you see, the first issue is, and that is also relevant from DHFL perspective, that even after resolution and settlement and finality, being a resolution plan reaching finality, the principles set by Supreme Court, despite availability of clear directions, lower courts still entertain various litigations, basically to get the applications of original promoter who is otherwise barred under 29A to proceed with the clarifications and subsequent orders. Like it could be from the jurisprudence angle, it can be justified on one pretext or the other, but Supreme Court is very clear that jurisprudence which has been settled by the apex court is not open for interpretation by lower court. So that part we have seen that it is coming up, 29A, as peoples associated with 29A are heading to various litigation and other courses to see that things are getting delayed, and the with delay is the erosion of value, which are also we are talking today. And the second issue which is coming up from these plans, resolution plans, is a minor one, but it has been, IBBI has been asked in the case of Videocon to see that during the COC meeting, there are so many professionals supporting RP present and disturbing the course of the meeting. So to come up with a regulatory provision to restrict the entry of large number of supporting professionals to the RP. So that part has been instructed to us, and we are trying to look into this, and would be seeing how best to deal, and if we have to limit the numbers entering the COC meeting room, then what should be the basis. So these things are being deliberated. We will be coming to public domain for comments, etc. also. The third is the context is, and in the recent judgments also, and resolution plans, you have seen a lot of discussion on haircuts, and from there, and even a standing committee saying haircuts, newspapers have picked up stories from there, basically that your vision of IBC is being defeated due to these massive haircuts which are coming forth. So on this, I have to make clear that though haircut is a concern, but it does not have either root or remedy in IBC. So I want to make it very clear in certain terms that basically this is not at all prescribed under IBC, or there is any root cause embedded in IBC which forces a particular kind of haircut. Therefore, there is a need that we have to understand and appreciate what is happening and why this phenomena is taking place. Because the relevant question to ask is to why does IBC process yield zero haircut in some cases and 100% haircut in another? Because if it was IBC induced, it should be uniform. So basically, we have to see that there are some market players which go into the whole theory of haircut, and it is not mandated by IBC as such. So critically, it depends on what stage of stress the company enters IBC process, as much as at what stage a patient arrives at the hospital. If entry stage is late, it is a sick unit, it is having no value assets, and judgment also says about tonsure. Basically, what we perceive is that basically if corporate person or corporate debtor is coming in a stage when there is no hair to begin with, then how IBC processes can create hairs to be shaven off later. So that issue needs to be seen, that at the time of entry, basically the company has stress or not, value, whether it has no value at the time of entry, and what percentage of value has deteriorated during the processes, that needs to be seen in this regard. So according to data we have, it is only when these companies which are going into liquidation, their asset value valued at 5% of amount due to creditors. So you can see at the entry stage of itself, 95% haircut is provisioned by the very definition that if you link it with the liquidation value. And then actually we see the third question, and also related to haircut. Many things are which are not counted as a realization. So that part we have to see that denominator is also robust enough to capture many things which happen post resolution. And one such thing is realizable value through equity holding. This is very much important, where resolution plan includes equity holding, and this is realized after company run in the process, and the value of the equity is realized over a period of time. Then we also see that it does not include much of the avoidance transaction. The data we have says around 4 lakh crores of avoidance transaction applications have been filed. It has to be established and recovered. So they do not come into the whole picture of haircuts which we discuss in the IBC. And the third is basically guarantors. Basically, we do not capture the way the guarantors have to be depicted in the resolution plan and how this recovery will take place. So this is basically these three elements actually fructify later on. So basically the haircut definition itself seems to be incomplete and needs changes. The fourth point, which is again coming from the judgment of Videocon, is resolution being around the liquidation values is seen as a breach of confidentiality. So this part we have been asked to examine. We will do. I cannot comment more than this, but I just remind that Apex Court in Maharashtra Seamless Limited has already given its observation that there is no provision in the code or regulations which prescribes that the realizable value has to match the liquidation value. So law position is very clear. It could be below LV also. It could be around LV. It could be more than LV, depending on the market, how it folds up. Then we have like next issue, if you see, and it was discussed in the first group discussions we had earlier, is on NCLT capacity. And basically, standing committee is rightly pointing out there is a problem. But if you see this year's budget speech, so enhancing and strengthening the NCLTs has been referred in the budget speech, and government is working towards it. So I cannot add more because government has made its intention clear that NCLT strengthening needs a serious relook. And the seventh issue basically is whether we should have a code of conduct of COC members. And this again is coming from the recommendations. Surely this is a work in progress. IPPI was working towards it. We thought self-regulating processes can work faster instead of a regulation. IBA was actually, in Indian Banking Association has been asked to come up with a code of conduct for COC members, and they have formed a committee and they are working on it. We will see it soon. And if it is delayed, of course, as a regulator, we cannot wait like for long to take decision on this. So we will be taking up, and as a regulation route if IBA processes don't fructify. So that is, and the last issue I wanted to say, because pre-pack has been mentioned as a mechanism, as a market, what I see is that the market has welcomed the initiative. There is a demand, one side, that you have to extend it to like large corporates, non-MSMEs, and also to non-corporate MSMEs. So there is a demand. Our theory has been, and our conviction and belief has been, that we have to gradually tread the path. First time we are trying towards a measure which is akin to mediation, and also we are trying basically creditor in debtor in control, basically a model to see that he retains the company till the process, first phase of the process goes on. So we will see how it unfolds. There is also some news items regarding its delay, like it has not been started being implemented. Our from IBPI and the government, the whole framework is available. We are doing advocacy. 100 programs have been happened, and what feedback we have from the banks, that they welcome it, but each bank is preparing SOP related to this pre-packs. So we are waiting for that, and I hope that with the SOP available, these things would be fructifying in due course. So I thought these were the critical items coming from various judgments and also resolution plan and the standing committee. I briefly touched upon them, and thank you once again for giving me this opportunity to share my thoughts. Thank you.
Thank you so much, Mr. Shukla. I think you touched all the critical points apart from the regulatory issues on cross-border insolvency, group insolvency. I think much of the other topics are hotly debated in terms of the effectiveness of IBC today, and very relevant points that you made. I'll just pick on one of that for taking the discussion forward. I think one of the recommendations from the standing committee report, as you mentioned rightly, has been bringing out a professional code of conduct for the COC. And that's our focus now in terms of a general approach of the lenders towards stress resolution, and specifically, what has been the impact of IBC, how have things changed after that, and what are the recent trends around lender approach to stress resolution. So I'll just give some pointers before I ask the question. I mean, since IBC came in 2017, it's become the primary resolution mechanism, obviously, as we all know. But it has also resulted in a very significant shift in the credit culture. Promoters, for the first time, are probably running behind banks to proactively pursue settlement of before it goes into IBC. For the first time, probably, you've got nearly 350 companies or a little bit more today as we stand, where there has been a change of ownership. It's been the first time it's happened in India. The recovery for financial creditors has been about 45% in an average time frame of 1.5 years, 1.6 years, versus 26% in 4.5 years earlier. There is clarity on waterfall today, which it wasn't there, and there's cleanup of past liabilities. I think all of these have been immense, I would say, push towards for the benefit of the lenders, resulting in the ease of doing business rank coming up from 136 to 52 last year. But I think the real question which I wanted to ask the panelists, and maybe you'll start with Ms. Vadera, who's had a view from RBI on how this has progressed, is how have you seen lender approach and lender behavior change, and what has been the impact and specifically the recent trends over the last year or so, ma'am?
Yeah, thank you, Mr. Dinkar, and very good afternoon to all. I mean, there's no doubt that, the IBC has been one of the major, economic reforms that has taken place in terms of aiming to resolve financial stress of companies. And the good thing is, that it has moved away from the erosion of net worth to a more objective criteria of default in payment criteria for initiation of insolvency proceedings. And I think one of the key, changes that we see on account of the IBC is the change that it is brought about in the behavioral, attitudes of the creditor and the debtor. And to your question, what has been the approach of the lenders here? No doubt, the IBC has led to a deeper, healthy, and more responsible approach to lending. There has been no doubt on that. And along with that, the stressed asset resolution framework of the Reserve Bank, which had been introduced in the 7th of June 2019, which also looks at a time-bound resolution of stress. I think both combined, the IBC and the stressed asset resolution and framework of the RBI has resulted in, an early recognition of stress in an account and then reporting the same and therefore bringing about resolution in time. So this early recognition is material in terms of taking timely action to resolve, because if you go at a stage where the stress is already, been there for a while, it gets more difficult to resolve the asset. And so therefore this early recognition, which has now been, impressed upon banks to kind of look at in terms of their stress portfolio, definitely I would say a plus. And in terms of the resolution framework also, that has come of the 7th June framework that I'm talking about, I think, the various incentives and disincentives that have been built up, disincentives in terms of, if the resolution process is delayed, then there's a kind of, imposition on the banks to make additional provisioning requirement if the resolution doesn't happen within a prescribed time frame. And an incentive has been built in terms of ensuring that, okay, if you have filed, for resolution under the IBC, and you can write back, 50% of the additional provisioning requirement, and the balance once the case is admitted. So there is an indirect, pressure on the banks to kind of go for early resolution, failing which it would be advisable to kind of go to the IBC route. And I think in that sense, we do see a perceptible change in the whole approach of the lenders. And I think they themselves are also a little more heartened, because now they have control over the assets of the defaulting borrower, which was not there, earlier. So that also puts the borrower on the toes to kind of, cure the default in time rather than move to an IBC resolution process. So definitely there has been a perceptible improvement in the approach of the lenders.
Thank you so much, ma'am. I think very important point, and I think that's one of the significant ones, is that the trigger for action earlier used to be NPA, and post that deterioration in value. I think IBC has brought that trigger to default, and hopefully with early recognition norms and better corporate governance, that trigger will be even further brought towards potential default rather than actual default happening. And the second thing is lenders trying to resolve earlier to protect value and better behavior, as you rightly say. Anilji, you've been dealing with lenders for a long period of time before IBC and during IBC. What has been your experience, and how are they looking at it, and especially over the last couple of years?
Thank you, Dinkar. In fact, my internet stopped for a while and I'm back. Thank you, CII, for this opportunity. So the lenders, of course, have started depending more on the IBC only. There are no other alternatives to our understanding. The lenders are only depending upon the all are stopped. the, as I said, this CDR, SDR, S4A, Joint Lending Forum, they were all withdrawn as RBI schemes in February 2018. BIFR was repealed on 1st of December 2016. So presently there are only two options. One is the IBC and the SURFACE. The RBI circular dated 7th June 2019, where it is mandatory, it is only applicable to the RBI regulated lenders, has not seen much success, because like the intercreditors agreement has to be entered into by 75% of the total debt, 60% in numbers. All all those lenders who are not regulated by RBI are not inclined to participate. There is no judicial stamp in this process. No applicability of Section 53. Hydra had popping up. So all these, the circular and all other options are almost closed. So they only look at the IBC, and everyone, in fact, is looking at the kind of some changes which are required in IBC, so that they can go big way for IBC only for restructuring and for the default. PPIRP, like prepackaged insolvency resolution process, is an extended arm which is most welcome so far as, but then I feel that the work has not started. The banks have not come out with their internal policies. But this is something which is much welcomed by the lenders. They are understanding it. They are trying to understand the benefits, like we all are advocating it for a while now, and the understanding is being developed. As I said, I think the lenders probably they are only looking at the IBC because their internal restructuring is not getting effective. They have also seen the results of CDR in the past 20 years and SDRs. So I think the most important approach that the lenders are now looking at is the fastest kind of discovery of default, fastest action. The hurdle presently is that a lot of time is being taken in admission, and I think recently the IBBA has come out with the form CIRP 8, which actually requires that the RP is supposed to kind of quantify the loss which has been, or the diminishing of the asset which has happened during the period while the application was pending before NCLT. So that actually has been the main hurdle, because the value diminution, because when the promoters, they have a understanding that they would not be able to save the company, then they go right, left, and whatever they can do for shifting of the assets, sale or transfer of the assets, diversion of the assets, and whatever they can do for milking the corporate debtor, that they do. So that period, in case it is restricted to maximum 30 days, so that they don't get any time to divert or play with the public money. So that's the primary difficulty. Otherwise, this is a most valuable piece of law for handling the stressed assets of the lenders, and as well as the kind of for the revival of the corporate debtors wherever the business is viable. Thank you.
Thank you, Anilji. Rajiv, I think in addition to what has been said, and because you look at this, apart from the insolvency side, you look at this from a valuation side as well. So will be very interesting to hear your thoughts on how the value journey happens, and as you've seen, when probably the deterioration would have started until the time action or recognition was done by the banks, and by the time the asset is admitted into insolvency, and by the time the resolution happens. Will be interesting to your perspectives on that. Apart from in general, how are lenders how have lenders evolved?
So, Dinkar, thank you for having me here, and thank you, CII. So I have some more uh, different thoughts here. So while the comparison is being made about the success of IBC, the benchmarking is what was pre-IBC and what is that we have today. So undoubtedly, it is a great success. But it is the phenomenon is more like dil mange more, because we have IBC now. The expectation of the lender community and everyone has also changed. So while definitely IBC is an unqualified success, but the events of last 2-3 years after the big bang, the top 12, top 20 cases are done and dusted. There is a disillusionment being set up amongst the lender community and everyone in general, the ecosystem, because of the inordinate delays that are happening. And if I can say maybe two major points, one is, and other speakers have also alluded to it, is the lack of judicial bandwidth and sort of inconsistency in the judicial pronouncements. If I can use the stronger word, some of them are really whimsical judgments which perhaps should not have come. So there is a sort of a disillusionment being set in. So today, if I can say, if the lender community prefers IBC as the first course of action, I would have my own doubts. Because of the delay that are happening, it is being considered as a last resort rather than the first resort. Now, as it is being considered as the last resort, there is a significant value diminution which is happening, because you bring the patient to the hospital where there is nothing left to be saved. And what essentially COC is looking for it is an insurance policy for itself, that yes, I'm taking this haircut, there's this judicial approval to it, so I've done whatever I could have done. So is that the right approach? I have my own doubts on that, because the need is for, and this is a zero-sum game. I mean, one feeds the other. If we speak to the lenders and the COC, their argument is that it is taking so much time that we try everything else before bringing it to IBC. And when we bring it to IBC, the expectation is clear that there is hardly any recovery which is going to happen. If anything could have been saved, we would have already done it. So whatever is being pushed to IBC is whatever, there is nothing left to recover from there. I mean, this is the practical situation, while the intent of law was very, very different. And I'm talking about the practical situation when I speak to the lenders and the COC today. What I hear is that, yes, now we've tried all the mechanisms, everything else has failed. So we'll push it to IBC and thereby get an insurance policy. Now, whatever is being done has a legal approval to it. So is that the intention of IBC? I have my doubts on that. So as I think many other speakers have also said, and in fact, regulators have also said, that time to use IBC is much, much earlier. And it should be used as a first resort rather than the last remaining resort. In terms of what value destruction is happening, so obviously, one is that good quality assets, barring the top 20 which were brought, the good quality assets are not being brought to IBC. Why there is so much haircut? One is the two reasons. Good quality assets are being resolved outside IBC. And if bad quality assets are being brought after everything is being attempted, and with the level of judicial delays that we have, the haircut and the extent of haircut is very natural. Because if you bring good quality assets within a certain timeline, the quality of the recovery which will happen, the extent of haircut which will happen, it will be much, much less. And IBC will sound a far better success than what it is today. Now, this needs to be, I mean, we need to convince the COC and the lending community that IBC should be used much earlier and in a way where a resolution is possible. But again, the challenge again is that they also have a very valid argument, because the inordinate delays which is happening, Anilji just said that before it is admitted, I mean, you take 1 year, 6 months, 9 months, that gives a great opportunity to the erstwhile promoter to milk the company and do whatever it wants to do. I mean, and it is one thing it is to say that look into avoidance transactions, look into the preferential transactions and all. But in practice, how much IP and an RP is able to do, because the promoter who is in charge knows that all this is going to happen. He has 9 months or 1 year to do and design whatever he wants to do in a way which cannot be discovered. The quality of forensic audit or whatever you do thereafter is spending good money after bad money. My sense is that last 2-3 years, there is a disillusionment being set in. Also, since you mentioned the valuation issue, see, the quality of bids, the level of interest that was there was very, very high if good quality assets are being brought in. As bad quality assets are being pushed into IBC, the level of interest is diminishing. Any which ways, we have a very, very poor depth in the distress asset market. So whenever we don't have a good quality distress asset market. When for a distress asset market to develop, good quality assets have to come into that market. Now that is actually not happening. And if you speak to any of the distress funds, any good quality ARCs, there is the challenge is that no, we don't have good quality assets in the market. Now, if there is good quality assets, there is sufficient competition, sufficient capital available. That's my 2 cents on this. And value destruction is indeed happening. But my point is, it is not because of IBC. Value destruction has already happened. And then IBC is being used as a cover.
Thank you. I think this is a very wide range of views from all three of you, which is kind of, if I try and marry these, I think what is happening is that initially with the push from the government, with the push from the RBI, the initial set of the large assets were taken into IBC when there was significant value still left and there was time for action there. And there was intent behind that from everybody to make it a success. But since then, I think, and in particularly, I think the size of the assets have reduced in terms of the size of the loans per se. I mean, the size of exposures have come down, the number of assets have gone up, the law evolution has taken its own time, and the NCLT bandwidth has also come under significant pressure, because of which I agree, lenders have tried to, put their figure out ways and means to resolve assets under the June 2019 circular, or OTSs, raising money from foreign funds who can come in and bail these companies out. But to Anilji's point also is that in some of these cases this has happened, but in many of these cases, the lack of consensus amongst lenders, whether it is on account of RBI covered lenders versus non-RBI covered lenders, or on account of purely indecision by some banks owing to the CCC fear that's there, has frustrated some of these attempts to discover and resolve pre-IBC. And by the time they end up into IBC, the value has already deteriorated significantly, because of which the processes, along with the litigations and uncertainties, take their own time.
I will also like to add, Dinkar, when you finish. I agree with Rajiv that the lenders at present, they are somehow thinking that the IBC may further diminish the value. Let us understand the reason for that. Now, the reason for that is not that there is anything else available which is better than IBC. The reason for that is like the IBC is also, because of the delays, may not deliver immediately. See, there is no other structured way of resolving financial stress. Having meetings with the promoters or trying to find out an investor, the investors would also hesitate in coming at this particular stage when the company is under financial stress, because the investor will not get clean slate. There is no Section 53 provisions when we do any kind of restructuring or revival outside the IBC. Let us understand what are the options available outside IBC. SARFAESI is not applicable to more or less not having any significant success for the businesses which are having a going concern, which are actually working. The surface is primarily for the asset liquidation. What are the structures available outside IBC? Is there any clean slate available? Is there any protection available to the investor or the new partner who actually may bring some money, or any fund coming from overseas and investing in that company, even if that company is viable? You see, you can get only a clean slate, you can get only under IBC. Now, in case you crack this hurdle, in case the cases are admitted to insolvency, say maximum within 30 days, then what are the other options which are better than IBC? And even we say that let us presently see, under the present circumstances where there are a lot of hurdles, a lot of negativity which is like spreading around about IBC, at times because of the standing committee on finance and because of some various allegations on the insolvency professionals. But see, the need now has actually been felt that the COC is also responsible for delay and NCLT is also responsible for delay. And these both, when the RP tries to keep the company as a going concern, RP needs some funds. When the interim finance is not available and the RP is asked to keep the company as a going concern, that actually would not be possible without funds. And how can we say that the value is diminishing because of the IBC? The law provides for the everything, but then the law is not being abided by. The COC is not giving the money to RP for keeping the company as a going concern, protecting and preserving the assets of the company and the businesses of the company. That is what is the primary difficulty as of now. The delay in acceptance, COC is not providing funds for keeping the company and protecting the value of the assets, and also the promoters are totally against this insolvency process, so they try to take away whatever they can, and there are no strong precedences set by the judicial pronouncements where the promoters will shy away in doing such things. They still continue to do all these transactions which are avoidance transactions, fraudulent transactions, and the reason is that they have not seen any adverse implication on anyone's life so far. So in case we only remove 2-3 hurdles: one, admittance of the cases within 30 days, COC code of conduct, which should also provide the legitimate money which is available for the keeping the company as a going concern and protecting and preserving the assets. And third, in case we can take stringent actions on the fraudulent transactions or removal of the property, including the removal of the books of accounts and records. So if these 3-4 things are corrected under the IBC, I would probably see that there is no other available framework for better resolution of the financial stress of the companies. Thank you.
Thank you, Anilji. I think great points on how to strengthen IBC, and I think I'll want to hear even Rajiv's view and Ms. Vadera's view on how IBC can be strengthened. But a very short point to add on to what you say is, yes, we need a strong IBC to be a deterrent for action and to keep promoters honest. But we also need other strong resolution mechanisms. You're absolutely right. Nothing is working today in practice, but I think before we get on to that, I think my first question, given a view in RBI to Ms. Vadera, is that how can we make some of these others more strong than where they are today, whether it's the June 2019 framework or any other intra-lender bilateral pre-insolvency mechanism? How do we make that work better in practice? Because this is a commercial problem and needs to be resolved by the commercial participants, and needs a strong law to back it up. So how do we make the commercial participants resolve this before we try and take this elsewhere?
Yeah. So if you had, I think one of my co-speakers did mention there were several schemes that were in place before the IBC came in or before the 7th June circular was implemented. So you had the, CDR mechanism, the S4A, and the SDR mechanisms which were there. But clearly, those schemes which were there were before we had a proper insolvency framework in place. And given that there was no, specific timeline within which a resolution would happen, it just, carried on endlessly and even resulting in an evergreening several times, which didn't really, yield any value. But once the IBC came and that whole stricture about a time-bound resolution to preserve the economic value of the asset, I think that was the key change that came, and the 7 June circular also builds on that. Having said that, in terms of the implementation of the 7 June circular, with only the regulated entities of RBI really, on whom the circular can be kind of enforced. And the other regulators, it has been impressed upon them to kind of join the, the resolution framework under the 7 June. While some regulators have already kind of joined in terms of, the insurance regulator, others are still kind of in, debating whether they should get into this or not because the interests are different. But having said that, apart from the 7 June circular, which to my mind has brought in a lot of credit discipline, there are other schemes available in terms of during the restructuring process, whether you want to get into a one-time settlement and resolve your debt rather than prolonging the whole issue and not kind of repaying. So I think a lot of it depends on the intent of the promoter. I mean, how keen is he to kind of cooperate with the lender to resolve the resolution rather than getting into delaying tactics and therefore prolonging the whole process of resolution. So I think a lot does depend on the corporate borrowers to also kind of cooperate with the lenders. And then, of course, for the lenders to take a decision rather than, I do agree that there needs to be some code of conduct for the COCs, and so that they kind of agree to a uniform kind of a resolution plan which is acceptable to all. So I think the key is the cooperation between the borrower and the lender, which is, I think, to my mind, key in any resolution process that comes forward.
Yeah, and
even see, Dinkar, even I'm telling you, the COC's behavior, like out of for example, out of 30 cases, there are 10 cases where the RP has not got even a single paisa of his fees for the last 1 year. I mean, in case the COC expects a person to spend from his own pocket, they will not contribute for even his expenditure. They will not even give him a 1 paisa of the fee. The valuers are waiting for their fee for the last 2 years. See, how can you expect that everything is on insolvency professional? The COC is not at all guided. COC actually still like 30% cases, the COC has the insolvency professional, the valuers, the forensic auditors, they have not got even single paisa for the last 1 year. 30% cases. And everyone is expecting everything from insolvency professionals.
that's a reflection of the earlier discussion, or the fact that I mean, by the time it reaches there, the lenders do not expect anything out of it. So they're just letting it and don't want to invest any more good money behind bad money. I guess that's the reason. But I guess, how do we make this better, right? Anilji, you mentioned 3 points on how do we make insolvency better. So maybe I just go around asking.
Yeah, sorry. Yeah.
So just to interject there, so I think the best way, I mean, each of these paths available for resolution would have its pluses and minuses. And the need is for having multiple mechanisms available. We need to strengthen each one of them in their different ways. Now, if there is a June 7 circular available with us, can RBI consider it making a little more flexible? Because what we hear from market, it is too rigid. How to get these inter-creditor agreements signed, how to get all of these people on board. Maybe that could be a suitable mechanism where a clean slate is not required. Because the issue is only debt, not other issues relating to clean slate, not other problems. Now, that could work provided RBI offers a more flexibility there. Second, IBC, I think if we can just get the judicial bandwidth to improve, and I wonder, I mean, can't we get 100 judges in India out of 130 crore people? I mean, I wonder. And if we can get 2,000 insolvency professionals, 20,000 lawyers, can't we get 100 judges in India? I mean, that's something which I think it's difficult to understand. If that single thing is done and judicial speed is brought about and there is a judicial discipline, I think IBC could be the best mechanism because it offers you clean slate. And if it offers you quick decision making, that perhaps that could be the best mechanism to go. Obviously, there are other things and other options available. Doing an OTS where distress funds, ARCs can come and finance it. I mean, if that can, but again, that would require a quicker commercial wisdom and quicker commercial decision making by the COC, if that can be done. So each mechanism would have its pluses and minuses. IBC by far could be the best, provided we can speed up the decision making. And obviously, we are yet to see the pre-pack. I mean, pre-pack could offer you the best of both worlds. It could have the benefit of the confidence of the promoter because he continues to retain the company. You have the judicial backing as well. You have the IBC. But let us see if pre-pack works. And I'm genuinely hoping that the pre-pack works. But each of these parts would have their own pluses and minuses. And we need all of them because every solution is different and you need just to improve each one of them wherever they are lacking. That's my 2 cents on this.
Yeah, Mr. Dera.
Yeah, just to kind of take it further to the point that is just being made. The IBC route definitely, to my mind, is one of the very good options that are available in the resolution of distressed assets. There's no doubt about that. But I think what is key and which will incentivize even the lenders to go that route is to kind of address the delays that take place, and that has been kind of said by several speakers even before me. And if you look at the classic case of the SR Steel, it took almost 841 days for the resolution to kind of happen. And in the meantime, the value of that asset and the time value of money, it took almost 2 years. And therefore, that gets deteriorated. So to my mind, I think if we can address the delays that happen in the whole resolution process at IBC, would actually be a key to make it, a stronger mechanism for resolution. And I think in that direction, the Standing Committee of Finance has made some, very critical recommendations in terms of strengthening the resolution professionals, making them more, qualified, and because after all, they are the key people who run that organization during that period when the promoter loses control. And of course, the recommendations on the COC and that whole, all the stakeholders at every level, if that is kind of strengthened and the judicial delays are kind of reduced, would be very, very crucial. In fact, some of the experiences that we did see was very often when a case went to the NCLT, there were decisions which, had to be taken for further litigation to either the NCLAT or to the Supreme Court. And as the Standing Committee of Finance has rightly observed, a lot was, coming to question on the quality of judgment that was coming in the NCLTs. And when you went to the higher courts, the decision did get reversed. But in the process, you lost some crucial time for a resolution, which kind of delayed the process. And every time the IBC, process was put to kind of test under various courts and litigations and cross litigation. So I think delay is the key thing that kind of needs to be addressed. And I think IBC is definitely the way forward, and probably just to fix the gaps that are there. And as far as the pre-pack which has come for the MSMEs, I think it's a good proposal to begin with, to kind of test it with the MSMEs to see how it kind of pans out before we kind of look at extending it to other entities. Thanks.
Thank you. Anilji, any thoughts before? I think we are running out of time. So any thoughts finally, apart from what you said on improving?
I definitely would finally say that this, in case we need this IBC to be the best option, legally and practically both, as Rajiv has touched upon the practical part of it, and all speakers are also touching the legal and practical part of it. So in case we need IBC to become the first option practically and legally, then I think there are certain things that we need to assure that admission within maximum 30 days from the filing of the application by any creditor, the effective judicial infrastructure so that there is no delay, professional code of conduct for committee of creditors, guidelines for committee of creditors regarding selection of a resolution professional, and it should not be only based on the fee. Promoting private investment in the stressed asset, and we should not expect everything from the existing lenders. The private investment will come only in case they find a clean slate, and nobody would like to buy uncertainty. So in case we give them something which is certain, clean, and without any hydra heads popping up, then the private investment will come. All that we talk about, ARCs or funds, domestic or international, they all will participate into these stressed assets, provided they are given clean slate, legal protection. And see, there are some things which are obvious as per the IBC, because see, the section 53 is very clear that the statutory liabilities are operational creditors. And the benches, when we file a resolution plan, it is very clear that the liquidation value is not even sufficient for the secured creditor. Why the benches are feeling it difficult that other than these secured creditors, all other liabilities are extinguished, they are hesitating in writing this. So because they are not writing this, the resolution applicant is supposed to go to from pillar to post for getting all these waivers, and he is actually getting claims, and every new head pops up every day. So that is providing some kind of uncertainty, discomfort to the investors, private investors, the entrepreneur. So these are some things which are actually required, and this law will become the best for the commercial India. Thank you.
Thank you, Anilji. I think I'll just take 2 minutes, Danish, to kind of get sum this up. And while I think all of us agree here that a strong IBC is necessary as a deterrent as well as a resolution mechanism for stress resolution. There have been suggestions for that from the recommendation from the standing committee, which has been, a lot of them have been also echoed by the panelists here. I think one or two things from my own perspective which I wanted to add is that NCLT revamp has been spoken about by everyone. And apart from the numbers there, I also think that you would want people with a little bit more commercial exposure or panels of corporate exposure to assist these NCLTs to come to a decision which is commercially good in nature. Secondly, I think there should be a barrier for litigations in terms of either fees, or if it is decided by the court that it's frivolous, then there should be fines imposed on that, which can deter litigations which are not necessary. And the third is the digitization bit, which can help slot meetings and hearings on time, can help get case laws across the board so that there is consistency in orders, which can really help the efficiency of the NCLTs significantly. And the last bit is this deemed admission thing, which I think Anilji said within 30 days. I would say if the IU, information utilities, become stronger and there are everybody is encouraged, all lenders are encouraged to register their debts, then as soon as that is registered, and if there is a default, then it should be an automatic deemed admission, which needs to be proved. Otherwise, there's no point in it hanging around without that. Without that happening. I think some of these are specific ones which I wanted to add to the NCLT revamp mechanism, really. And pre-packs we've spoken about in detail. I think I may make a controversial comment here, but which has also been discussed. But the similar relaxation for MSMEs that has been given for 29A, that I think such relaxation should be allowed for other corporates also. Going forward, if we want to really resolve the huge mass of stressed assets that we have going forward. So I'll pause there, and if there are any questions in the box, I'll take that. Mr. Shukla, do you want to say anything before we close?
Yeah, actually, if you allow me to, because I have seen this in intense debate and very good points coming out of it. But for one inordinate delay, actually, one has to be wary of the fact that basically we, even today, if you compare with other mechanism available, it is time is increasing. It has become for 108 days now to dispose of a case. But if you see the erstwhile regime, which was taking more than 1500 days to get done, this is far better option still. We tried, Parliament intervened to say to make 330 days mandatory, but court has struck it down and make it directory. So that is, we have to be cognizant of the fact that judiciary has to decide and take time as it wishes, so in accordance with whatever is required for the court. So we tried through legislative intervention, but somehow it could not pass the muster of the judicial scrutiny. Second point I just wanted to make, it is a package actually. IBC comes with a package, moratorium and other things basically, and the blessings of the other which you say comparable grievance redressal or redressal programs are not getting those blessings. So maybe you have to see the package as a whole when you compare. Strengthening others is, of course, desirable, but due to the lacunas in other options, IBC has come forward. So we have to see that IBC, when it was promulgated, it was basically to address the problem of the elsewhile regime. So again, IBC, I thought, stood out in terms of package as a whole. I heard about the cases like liquidation and other debate, but what we are not accounting for is about 19,000 cases which are withdrawn after being admitted under the processes, sometimes before admission itself. So they are fetching actually this behavioral change, which we always say, but today I could not hear. But it is credible from the creditor's point of view, this behavioral change to settle the account before initiating IBC has been the tremendous success. And when we say liquidation versus resolution, then account for these 19,000 cases which were settled due to threat of IBC. So this is very important point one has to see. On pre-pack, I heard that you said basically it's a 29A relaxation. I just want to say and add that 29A relaxation has not been granted per se. It was available under 241A for MSMEs already, which has been extended there. So there is no specific carve out other than what code provides for MSME for 29A relaxation. So this is 29A is again the backbone of the regime to start with the clean slate, and if we relax that, perhaps the edifice will crumble. So these are my points I thought I would want to say, since you have given me the opportunity to intervene. Thank you.
Thank you, Mr. Shukla. I think we've run out of our time allotted. So I think, can I ask one of the CII team to make the further announcement on this? Thank you so much to all the esteemed panelists for joining me for this discussion.
Thank you so much, Mr. Dinkar, and thank you all the esteemed speakers. My request is that we will be taking a short break, a lunch break kind of, and we will rejoin at 1:30 for a very important session on recent policy and judicial developments towards IBC 2.0. So thank you all, and please, all of you, please join us back at 1:30 for the next session.
Thank you. Thank you very much.
Thank you.
Thank you very much, Mr. Clark. Thank you.
इन्होंने खेल नहीं कर